Hey everyone, welcome to The Explainer. Today we are diving deep into a literally massive shift in the future of lending architecture. If you've been, watching the financial sector lately, you can feel the ground shifting right beneath our feet. The research points to a really fascinating transition here. We're moving away from the old days of those monolithic, rigid, batch-processed banking platforms, and we're stepping into this highly agile era of composable, event-driven microservices. But look, this isn't just some nice-to-have IT upgrade. It is quite literally a matter of absolute survival. Let's get right into it. 12.5x. Now, that is not a revenue multiple. It's not some aggressive growth target. This is the staggering cost multiplier that banks are going to face for a downgraded loan under upcoming regulatory changes in India. So just imagine the sheer financial shock of your capital provisioning jumping 12.5 times overnight simply because a borrower's risk profile slipped. And the reality is, legacy batch process systems, they just can't handle this kind of real-time volatility. No way.
Let's actually break down the math behind the shock, because it reveals a huge shift. The Reserve Bank of India is introducing a new expected credit loss framework, and it essentially classifies loans into 3 stages. For stage 1, which is your healthy borrower, it requires a pretty minimal 0.40% in provisioning. But the very second that borrower shows an increased risk and drops to stage 2, the bank has to provision up to 5%. That right there, that's your 12.5x jump. And if they hit stage 3, meaning they are credit impaired, you're provisioning for the lifetime expected loss of that entire loan. So the absolute crucial takeaways here is the financial urgency of avoiding that drop from stage 1 to stage 2. If your systems can't see that drop coming in real time, well, your capital gets locked up, and it gets locked up fast.
Okay, so to figure out how our systems can actually survive this, here is our blueprint for today. First, we'll look at the expected credit loss shift. Then, we'll talk about decoupling origination and management. After that, architecting the modern LOS, managing post-disbursement via the LMS, and finally, we'll wrap up with the intelligent lending future. All right, let's kick off with Section 1. The expected credit loss shift, or as I like to call it, the impending regulatory burning platform. Let's go. So let's define exactly what we're dealing with here. The expected credit loss, or ECL framework, is a massive regulatory shift. Up until now, banks have operated on what's called an incurred loss model. A loan defaulted, you saw the loss, and you booked it. Simple. But the ECL framework requires banks to provision for losses they expect to happen. Think about that paradigm shift for a second. It's basically forcing the whole banking mindset to operate much more like an insurance company. You have to predict the risk before it materializes. You can't just wait around and react anymore. And here is the ticking clock. April 1, 2027. That is when the RBI's new ECL framework becomes a reality. And the sources point out a really major vulnerability here, those legacy core banking systems. The monolithic ones that rely on manual handoffs, overnight batch jobs, and hard-coded credit rules, they're practically blind until the end of the month. They absolutely cannot handle the real-time foresight required to predict these expected losses. So if you are still running on a monolith in 2027, honestly, you're flying blind right into a storm. Now, the math for this ECL shift runs on 3 really complex parameters: probability of default, loss given default, and exposure at default. And these aren't static numbers, they are highly dynamic. On top of that, real-time credit score fluctuations, like say a borrower's CIBIL score suddenly dropping to 730 or below, will now trigger massive downstream costs and instant shifts in your capital requirements. Recalculating all these dynamic variables requires a real-time orchestration engine. It totally exposes the weakness of legacy systems that rely on delayed overnight settlements. Your architecture literally needs to ingest alternative data and recalculate risk on the fly, instantly. Okay, moving right along to Section 2, decoupling origination and management. This is where we move from those clunky monoliths to a slick, composable architecture. So the foundational engineering solution here is to basically take a cleaver to the legacy platform and chop it right in half. On the origination side, we have the Loan Origination System, or LOS. This is your pre-disbursement engine. It's all about capturing the lead, verifying KYC, running credit checks, underwriting, and finally approving. Then on the management side is the Loan Management System, the LMS. This handles everything post-disbursement. We're talking EMI scheduling, interest calculations, collections, prepayments, and closure. Decoupling these 2 systems is the absolute cornerstone of modern banking. It lets you build a headless, API-first microservices architecture, meaning you can update your origination rules on the fly without ever breaking your core ledger. It's pretty brilliant.
Section 3, Architecting the Modern LOS. Let's dig into engineering that pre-disbursement workflow. Here's what that rapid LOS journey looks like, broken down into 4 key steps. First, lead capture and digital application. You're aiming for under a 2-minute time to apply, using omnichannel SDKs and embeddable widgets. Second, KYC, AML, and bureau integration, all pulled instantly via API orchestrations. Third, underwriting and credit decisioning, which is executed by real-time machine learning risk models. And finally, sanction and disbursement, enabling instant payouts that trigger automated smart contracts or cloud ledgers. Because we've decoupled the system and adopted this API-first approach, the whole thing is just a continuous, perfectly automated flow of data.
And what's the ultimate goal of all this decoupled engineering? Faster turnaround time and maximum straight-through processing, known as STP. By orchestrating these APIs, latency drops to under 200 milliseconds. That is blazing fast. It allows your systems to process an application from end to end without any human intervention. This dramatically reduces your operational risk and ensures that your credit rules are applied perfectly every single time, all while slashing application times and keeping those drop-off rates super low. All right, let's look at the other side in Section 4, managing post-disbursement via the LMS. Because, disbursement isn't the end of the journey, it's really the beginning of the long-term customer lifecycle. You have to think of the LMS as this massive integration fabric. To be effective, an LMS has to seamlessly connect with the core banking system, payment gateways, Natch or auto debit services, notification platforms, collections, and document management systems. And in a composable architecture, these aren't those clunky old batch integrations. No, they are real-time, event-driven connections, often utilizing message queues like Kafka. This event-driven architecture ensures zero reconciliation lag. That means high-volume payment spikes will never crash your core ledger. A payment is made via a gateway, and boom, it is instantly reconciled. There's a quote from the research that I think hits the nail on the head here. It says, "An LMS manages the entire post-disbursement lifecycle, ensuring repayments are tracked, collections are handled efficiently, and loans are closed in compliance." Remember that expected credit loss framework we talked about earlier? Well, this is exactly how you survive it. Tracking automated delinquency signals via this event stream is the exact mechanism that prevents a healthy Stage 1 loan from quietly slipping into that highly costly Stage 2. It gives you the exact real-time visibility you so desperately need. Section 5 already. The intelligent lending future, focusing on embedding AI and automation. Because your architecture is now made up of these independent microservices, you can just easily plug in these incredible automation modules. You can add OCR-based document parsing for instant data extraction. You can deploy AI for lead scoring and prioritization, or integrate smart machine learning into your underwriting and decision engines. You can plug in advanced fraud detection and even run predictive collections that flag an early warning way before a borrower misses a payment. And the best part? Deploying these tools doesn't require massive, risky monolithic code overhauls anymore. It is a completely scalable, plug-and-play feature that ensures true enterprise readiness. So what does this all mean? Well, the research makes one thing abundantly clear. Legacy systems are going to severely struggle to survive the transition to an expected loss model. This new world demands foresight, it demands speed, and it absolutely demands real-time data integration. Embracing a decoupled, API-driven architecture that divides the LOS and LMS, well, it isn't just some fancy IT upgrade. It's a strategic necessity to protect your capital. Which leaves us with one critical, urgent question to ask about our own systems. Is your architecture actually ready for April 1, 2027? Think about it. Thank you so much for joining me on this explainer, and I'll see you next time.